This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend Taylor from Life Goal Investments, 10-year Wall Street veteran, and that will become important for this topic. How you doing, bud?
Yeah, let's do it. Let's talk a little bit about banks, right? Here we go.
Yeah, exactly. We're going to talk about Credit Suisse.
Oh, I'm sorry, Credit Suisse. Right, yeah.
That's okay. That's right. We're going to relate it back to Lehman. So that's Lehman Brothers.
That's where my brain was going.
Yeah, that's okay. And I think that'll be really relevant for folks because I don't know if folks are following Credit Suisse. They've obviously had a rough couple of years, a couple of scandals. I think their stock's trading down to like $2 or something crazy. Their executives over the weekend were raising capital and making all their investors feel good about restructuring, and we're going to come back and be stronger. All I could think about was Lehman's CEO, the day before they went out, said, "We are well capitalized and we will be coming back." Like 12 hours before they went kaput, was out on TV declaring this and that. And I'm like, I'm sorry, when the CEO of a bank has to come out and reassure people, that's not a good feeling. So if you know something about Credit Suisse or what you've read, great. Otherwise, relate it to what happened in Lehman, because that was a watershed moment in the U.S. financial system.
It absolutely was. And so that was kind of the initial debacle that played out in 2008 when things started to really, really spiral. But soon thereafter, it was Bear Stearns, and you had this kind of plethora of all this negativity being built in. And what it came down to was just things that they had in their balance sheet that weren't good assets, right? It needs to be a good asset that has tangible value. And when the tangible value of that starts to swing meaningfully in one direction or the other, all of a sudden those assets don't get booked at the same value. And so that's when things can go from okay to really bad really quickly, is when all of those things systematically reprice at the same time and your balance sheet goes upside down. That's exactly what happened back in the Lehman days. That happened with Bear Stearns. And the scary thing about it was from a Wall Street perspective, is that people started to buy into this game of, oh, they'll be able to weather the storm. We understand that there's a little bit of cloudiness here right now, but we're actually getting a really good value. And then they doubled down in these stocks. And then obviously the knees just got literally cut out from underneath them. And that was what drove the downdraft that we saw of 50% of the S&P 500, peak to trough in 2008.
Yeah. One of the things going on over in Europe, I don't know if you saw this, but UK had a quick pivot. They were, raising rates, doing QT, suddenly did QE, tax pivot, all of this, and kind of scratched the surface only a little bit. It sounds like their pensions were on the cusp of margin calls and insolvency, scratching a little bit.
It was a panic. It was a panic buy. They went from selling bonds into the market, just like we are, quantitative tightening, to, oh boy, reversal. We're now going to stop tightening and we're going to go back to loosening and step in the market and buy bonds as a safety act.
Sounds like, and I bring this up because Warren Buffett has a great quote that I'll get to in a minute. It sounds like the pension companies were starting to use derivatives to amplify returns because they couldn't get a return in the last 2 years because rates were zero. Derivatives were famously termed by Warren Buffett as weapons of mass destruction. And if you really look at the 2008 crash, it was the derivative market, CDOs and the ilk or derivatives, that amplified the chaos and the pain. So let's talk about derivatives and why they can once again become weapons of mass destruction.
Yeah, a derivative is a synthetic instrument. So you don't actually own an asset, but it says, hey, if this underlying asset does this, then your piece of paper that's written against this will do this. And usually what it is a magnitude, a leverage vehicle. So if this goes up $1, you're going to go up $5. Well, guess what happens when this comes down $1? You come down $5 on the other side. So again, when you think about pensions, the problem with pensions for a number of years now is that the insurance part of the pension, the safety part of the pension, is fixed income, is bonds. When yields are incredibly, incredibly low on bonds, call it 1%, call it zero in Europe. So all of a sudden, they now have to pay out these pensions where long-term you've been able to assume that your pension could derive a 6-7% return over the long term. Now the biggest percentage of that is doing zero or darn near zero. So you now need to lever your book in order to pay those pension obligations in the back end. And it's been all a function of a low interest rate environment that we've been in now since 2008.
Yeah, again, if you're running one of these pensions and you're seeing withdrawal rates which have stayed constant, if not slightly higher, you're seeing return rates are actually going negative, you're dipping into principal to pay people out. It makes logical sense why you get these derivatives, but boy, when they turn, it's violent. And near as I can tell, there were many pensions on the cusp of insolvency because margin calls are real, and that's a problem.
And what you see is that although higher bond yields drives down prices in the short term, it's actually a very, very good thing for pensions to have higher bond yields available in the market, because then they can lock in that, in the US right now, 4-ish% or whatever it is on their treasury, and say, for the next 10 years, we know this fixed income treasury component of our portfolio is going to churn out 3.75%. And then we need to go out and figure out what we're going to do with the rest of the assets, whether it's commodities, stocks, private equity, whatever it is, to try to get us to that 6% bogey at the end of the day.
Yeah. So again, I don't have any color on what's going on at Credit Suisse. It just feels a lot like the US banks back in the day, all of them declaring strength and then, half of them going to zero overnight.
Yeah.
And again, derivatives, it's our ability to consistently make the same mistakes is shocking in the financial system. It's not good.
It really is. I mean, it's in every system. I think not just the financial
probably.
system. It's,
That's true.
what's Mark Twain's got the line. What is it? History doesn't repeat itself, but it rhymes. It does. If you look at the mistakes we've made, wars, et cetera, throughout history, all of it, you can go, okay, I could see a line of commonality in all of this. But yes, it repeats itself far too often here in the fixed income market, or I'm sorry, in the markets in general. And I do think that there's a lot to kind of the reversion back to the mean. And I think that, stocks got swung way too far in one direction in a positive way in 2021, 2020 with the stimulus checks, et cetera. And they're getting swung back in the other direction right now. And probably it'll go a little too far on the negative side before it comes back to where it should inevitably sit. But I mean, it shouldn't, these cycles come and go. We know they're coming and going. Just don't get over your skis in any one direction. Don't get too bearish when things are bad, like now, I think. And don't get too excited when things are really good at the end of 2021. That was euphoric.
Yeah, absolutely. Do me a favor. Where can people follow you, Taylor?
Yeah, follow us at Life Goal Investments on Instagram. That's the best place. Thanks for letting us plug us there.
Awesome. No problem. I love what you guys are doing. Daily stuff's very, very cool. I watch it every day.